Welcome to Customs GST Advisory Channel of CustomGST.com, where law is interpreted through statutes, constitutional principles, and judicial precedents, not assumptions. Every day, thousands of GST notices are issued across the country. And many of them begin with a simple assumption: commission was received, therefore GST is payable. It sounds logical. But is it legally correct? Can a mere accounting description determine tax liability? Can the label commission replace the statutory requirement of proving a taxable supply, or does the law require something much deeper? In today's episode, we explore one of the most important questions under the CGST Act. Can the department levy GST merely because a payment is described as commission without first proving the existence of a supply under Section 7? Together, we will analyze the statutory framework, examine the enduring principles laid down by the Supreme Court, and distinguish between commercial terminology and legal substance. Because GST is not a tax on words, it is a tax on legally recognized supplies. If you are a chartered accountant, cost accountant, advocate, GST practitioner, tax officer, business owner, or a student of indirect taxation, this discussion will change the way you analyze GST disputes. So join me as we uncover one of the biggest misconceptions in GST jurisprudence, the biggest mistake in GST, taxing commission without proving supply. Let's begin. Every GST officer, every consultant, every businessman has probably heard this statement: you received commission, therefore you provided a taxable service. But is that really the law, or is it merely an assumption? Today, we are going to dismantle one of the biggest misconceptions under GST, because the Supreme Court has already laid down a constitutional principle that most GST proceedings completely ignore. And once you understand this principle, you will never again assume that commission automatically means taxable supply. Many GST show cause notices follow a dangerous shortcut. They proceed like this: commission was received, therefore there must be a service, therefore GST is payable. Simple. Convenient. Wrong. Because taxation never begins with the amount received. Taxation begins with the legal nature of the transaction. The amount is only the consequence, the relationship is the foundation. Suppose I transfer rupees 10 crore to your bank account today. Can the GST department immediately issue a notice saying, you received money, therefore you supplied a service, therefore pay GST? Of course not. Now change only one fact. Instead of calling the payment transfer, call it commission. Does the legal position suddenly change? Absolutely not, because GST does not tax words. GST taxes legal transactions. And that is precisely where one of the biggest misconceptions under GST begins. Today we shall answer a fundamental constitutional question: does commission itself create a taxable supply, or must the department first prove that an actual supply exists under Section 7 of the CGST Act? One of the greatest intellectual mistakes in GST litigation is confusing money with taxable supply. Money is never the taxable event. Commission is never the taxable event. Brokerage is never the taxable event. Profit margin is never the taxable event. The taxable event under GST is supply. This is where Section 7 becomes revolutionary. It does not ask, how much money did you receive? It asks, was there a supply? Everything else comes later. Let's begin with the strongest example for commission not being a taxable supply. Suppose a manufacturer appoints a distributor. The agreement repeatedly uses the word commission. At first glance, it appears to be an agency. But now look deeper: the distributor purchases the goods in his own name. Ownership passes to him, commercial risk belongs to him. Customers purchase directly from the distributor. The distributor cannot legally bind the manufacturer. In substance, this is not an agency. It is a principal-to-principal trading relationship. Here, the so-called commission is merely the distributor's trading margin or pricing mechanism. The label may say commission, but the law asks a different question: was there an independent supply of service to the manufacturer? If the answer is number, the word commission alone cannot create GST liability. This is precisely why the Supreme Court reminds us, substance prevails over terminology. Now consider another example: a manufacturer normally sells goods for 100 rupees. Instead, he invoices the dealer for 96 rupees. The agreement, however, describes the 4 rupees as dealer commission, but what has actually happened? Has the dealer provided any independent marketing service? Has he acted as an agent? Has he represented the manufacturer before third parties? Number the 4 rupees merely reduce the purchase price. Economically, it is a trade discount. Calling it commission cannot change its legal character. GST is determined by the real transaction, not by creative accounting language. Now imagine two companies jointly execute a large infrastructure project. Instead of calling the distribution of profits profit share, the agreement uses the expression commission. Does the label decide GST? Certainly not. The first legal question remains, did one company actually provide an independent supply to the other? Or are they merely sharing the economic results of a common venture, if the payment is nothing more than profit allocation? The mere use of the word commission cannot automatically convert it into consideration for a taxable supply. Again, the answer depends upon the legal rights, not the terminology. Now let us move to the accounting department. Many companies internally record entries such as regional commission, branch commission, sales commission. But ask yourself who supplied whom. A company cannot provide services to itself. Internal accounting allocations, management reports, or performance incentives do not automatically create taxable supplies. Without two legally distinct persons entering into a taxable transaction, there can be no GST merely because an accounting ledger contains the word commission. Accounting entries explain finances. They do not create legal rights. Finally, consider a year-end commercial adjustment. A supplier agrees to reduce the final price after achieving a sales target. Instead of recording the adjustment as rebate or price reduction, the accountant records it as commission. Can accounting software rewrite tax law? Absolutely not. The legal nature of the payment remains exactly what it was, a price adjustment. The description in the books cannot convert one transaction into another. Under GST, substance always prevails over labels. Many GST investigations unconsciously follow this logic: commission received, therefore service. Therefore GST, it appears logical. But legally it is backwards. The law requires exactly the opposite. First, identify the supply. Then identify the consideration, not the other way around. The department cannot use the existence of payment to presume the existence of supply. That would invert Section 7 itself. The Supreme Court, while examining a service tax dispute in case of civil appeal numbers 2471 to 2473 of 2015, Commissioner of Service Tax Mumbai versus Bharat Petroleum Corporation Ltd, and others refused to be influenced by labels such as commission, profit margin, agency. Instead, it examined something far deeper: the actual contractual rights, the legal obligations. Who bore the commercial risk? Who owned the goods? Who could bind whom? Only after answering these questions did the court determine whether a taxable service actually existed. The judgment teaches a timeless lesson: legal substance prevails over commercial terminology. Commission is evidence, not proof itself. This distinction is extraordinarily important. Commission may indicate an agency. It may indicate marketing services. It may indicate business promotion. Or it may indicate nothing more than a pricing mechanism. The word commission raises a legal question. It does not answer that question. Because consideration never proves supply, supply must first be established independently. Agency cannot be created by accounting entries. One of the most misunderstood principles in taxation law is agency. Agency is never created because an invoice says commission. Agency exists only where legal authority exists. Can one party legally bind another? Can contracts be concluded on behalf of another? Does a fiduciary relationship exist? Who assumes legal responsibility? These are legal questions, not accounting questions. A ledger cannot create an agency that the contract itself does not create. Why the principle laid down by Honorable Supreme Court in case of Commissioner of Service Tax, Mumbai versus Bharat Petroleum Corporation Ltd referred earlier becomes even stronger under GST. Many people say this judgment belongs to service tax regime. GST is different. Yes, it is different, but the first statutory question remains identical. Before asking, is this a service? GST asks, is there a supply? Without establishing supply under Section 7, there can never be a taxable service under Section 102. The definition of service cannot replace the statutory requirement of supply. That is why Section 7 always comes first. Does this mean commission is never taxable? Absolutely not. Insurance agents, real estate brokers, Stockbrokers, marketing agents, commission agents, business facilitators. All may be liable to GST, but notice why. Not because they received commission, because they supplied an identifiable taxable service. The commission is only the consideration, the supply remains the taxable event. That distinction changes everything. The next time you receive a GST show cause notice merely because your books show commission received, do not immediately argue about exemptions, rates, or valuation. Ask a far more fundamental question. What exactly is the supply? Which contractual obligation was performed? Which legal right was transferred? Which service was independently supplied? If these questions remain unanswered, the foundation of the GST demand itself becomes questionable. Let us conclude this discussion. Civilizations progress not by taxing words, but by understanding legal concepts. GST does not tax labels. It taxes legally recognized supplies, commission, brokerage margin, incentive, or consultancy fee. None of these expressions automatically create GST liability. The real taxable event lies deeper in the legal relationship, in the contractual obligations, in the existence of an actual supply under Section 7. Perhaps the most important GST question is not, was commission received? The real constitutional question is, has the department first discharged its burden of proving that a taxable supply ever existed? Because if supply is not proved, GST cannot be presumed, and that may become one of the most important principles of GST litigation in the coming decade. If you believe GST should be governed by statutes and not assumptions, like and subscribe to this channel. Press bell icon for latest notification. Here we don't just discuss tax, we decode the constitutional architecture behind taxation. Thank you for watching.